Okay, so hello everyone. This is a bit of a sort of a macro overview, just why the market is closed today. For the record, it is Monday, February the 19th, 2024. Okay, so obviously, guys, what's happened is that over the last week or two, we've had strong economic data. We've had pretty strong initial jobless claims. We had very good non-farm payrolls. We've had just in general, economic data has been reasonably strong, with the exception of retail sales. But in January, retail sales are often a bit slow because it's the post-Christmas period. But allied to that, of course, has been a bit of a change in the narrative of inflation. So we all know that we had a higher than expected or hotter than expected CPI, and that was followed on a Friday, just a couple of days ago, by hotter than expected PPI. And the problem here is that I think what's happening is that there could be a little bit of a change in perception and narrative of the market. And obviously that's going to have an effect on all kinds of trades. So let's just do a quick, one minute recap. And this, I think, is where the market is repricing things. If you will remember, if we go back to December at the last Fed meeting, the market took that as a bit of a dovish kind of pivot. And if you guys remember here, we had that the Fed funds rate you see here before in September was 5.1. The Fed revised that down to 4.6 for 2024, and the market was pretty happy. The market said, okay, as you can see here, that the GDP was revised downwards. The PCE inflation was revised down. So just in very simple terms, what was going on in December? The Fed basically said we're going to start cutting a bit more than we had anticipated. The general economy, the GDP is slowing down, and inflation, there's a disinflation narrative. So everyone was happy. We saw the front end of the curve sort of rallying. We saw some bull steepening. We saw the bonds rally. Stocks were pretty happy as well. And that was like a sort of a happy, the so-called Goldilocks scenario. But basically what's happening is that over the last 5 or 6 weeks, so at the beginning of this year and coming in, as recently as we say last week with CPI and PPI, is that the market, I think, is now starting to get nervous that this narrative is going to change by the Fed. And what does that mean? That means that at the upcoming March meeting, which I think is March the 19th, I think the market is now saying, well, maybe some of the metrics, some of the measures in this SEP, Summary of Economic Projections, which of course we didn't get in January, it's going to be updated in March, might change. And if that changes, that could change the whole narrative, which of course is going to change the markets. So what's the key things which could change here? First of all, if we look at the real GDP, as you guys can see, in December, the Fed was estimating that to be only at 1.4 growth, 1.4% positive growth by the end of 2024. But the thing is that at the moment, I was just looking at the weekend at the latest GDP Now, the Atlanta Fed publishes, they try and do like a real-time estimate of GDP. A lot of people are saying that this number, it really could be 2.9 to 3%. It's difficult to forecast, but basically 2.9 to 3%. And so when you think about it, if you look over here on the right, you can see that even the range within the FOMC was 0.8 to 2.5. So it seems as though what's probably going to be happening in the real economy is that the GDP is going to be significantly above the most extreme measures of the Fed. So not even at, certainly not at 1.4, but maybe at 2.9 or 3%. So the first thing to keep in mind is that maybe the GDP will be revised upwards on the Summary of Economic Projections. And what is that saying? That's saying that what was the narrative, a couple of months ago? The narrative a couple of months ago was that, growth was reasonable, the labor market was slowing, inflation was going down towards target, and it was not a problem to cut. Okay. But now the narrative, I think, is shifting that growth is not just slowing, growth is actually maybe accelerating, and that maybe the neutral rate needs to be higher. And that, of course, the big problem is that we need to look at this number here, the Fed funds rate. Now, as you guys can see, last time they put that down to 4.6. Some commentators are saying that this might actually be revised upwards. So keep in mind, guys, what is this saying? This was going to be 3 cuts. Now let's just have a look here and just look at some scenarios. So if you look at this is the SOFR tool on the CME, which is kind of a handy tool. Okay, so if we actually look at this, this is what is currently priced in. Okay, so this is literally what is priced in right now in real time by the market. And as we can see, we have essentially, almost like 4 cuts are priced in by the market. Okay, that's what the market is saying. The Fed is saying 3 cuts. If you look at their last dot plot, they were saying 3 cuts in 2024 and 4 cuts in 2025. So the thing is, though, that if the Fed believes that growth is actually accelerating and that there's the possibility that in the dot plot, they might actually remove 1 cut. They might actually remove 1 cut. So we can play around with this tool and look at that and say, well, okay, now keep in mind we have an election. So let's do a hypothetical situation here. And we say that in November, the Fed will not want to be interfering with the political process. Because remember that historically, the Fed doesn't really like to cut or to hike around the election. So I'm going to say that between, let's say, September and November meetings, they'll do nothing. But let's say, for example, they cut once in, let's say, December, and maybe they don't cut. No, let's say, no, what we can do is say, okay, maybe 1 cut in June, maybe 1 in July. Now, if they want to signal to the market that inflation is actually going up a little bit and that growth is going up, rather than 25, maybe they might do something like, we can put mathematically half a cut. Okay, so you see what I've done here? Instead of saying, the market is saying 4 cuts, the Fed is saying 3, but there is a risk, a serious risk that in March, they might actually revise the dot plot up a little hawkishly. And I've said by like 10 or 12 basis points. Let's call it 12.5, which is 1. So that leaves us with 2.5. Okay. And then let's say, for example, we keep with what the Fed says. So we'll put in minus 25, minus 25. So we'll keep the 4. Okay. Now, what I want you guys to look at here, which is kind of interesting, is the SOFR, the term structure. And if this is our baseline scenario, based on the fact that we had strong CPI, strong PPI, and what a lot of people are saying is that the core PCE, which we're going to get on February the 29th, so what's that, in a couple of weeks or so, that may actually rise to 0.43. I was looking at the weekend. It seems the consensus is about 0.42, 0.43, which of course is heading in the wrong direction from the Fed. So there is a good possibility, or at least a possibility, that the Fed might revise their dots at the March meeting. So if that's the case, let's now recalculate or calculate where the market could be. Okay, so keep in mind, this is what the market is right now. And we're going to, boom, calculate with a potential new scenario. So what you can see is that it doesn't move a huge amount, but what it does do is that the predicted path of the SOFR contracts, which, as you guys know, is the 3-month short-term contracts, it might actually go lower in price, which of course is higher in yield. So what it's telling me is that the danger is that this whole narrative from last December, if the Fed wants to even just slightly kind of change that, slightly tweak it through the dot plot mechanism in March, coming up in a month or so, that means that maybe not so much the 2 or the 5-year yield, but maybe the shorter term bond contracts, let's say the SOFRs, let's say, see this one here, Z4, which is December 24, and even March 25, they're basically mispriced. They need to come down in price or the yield. And so how much? So we can see here that the differential there's about 28 basis points. So the point I'm trying to make here is that if we assume the Fed could do a slightly hawkish retweak, not a huge amount, it definitely means that the very front end of the curve is a little bit too priced too richly by about 25 or 30 basis points. And that could be a trading opportunity. So the first thing I'm thinking is that, and again, we can look at just a couple of charts here. Let's just start looking at a few charts. If we go to, sorry, I just have to find this. So this should be the daily. So what I want to look at first of all is just a couple of the yields here. Actually, the price, I just want to find so let's say, for example, December, the SOFR December 24 contract. Now, what we can see is that indeed, the price has gone down quite a lot. So there has been some hawkish repricing. So, but what I'm saying is that even of today, if the Fed wants to be a little more hawkish in March, this has maybe another 25 basis points, which is about 50 ticks. Okay, so that's kind of an interesting possibility. So first thing I'm looking at maybe as a trade, is that if we get some kind of rally, I would say that up to here, 95.73 could be a very interesting entry point for a short. And that could be even a spread trade. So I'm thinking something, hold on, let me just have a look at this here. So something we're looking at is if it gets up here, which is about 14 basis points away, with the idea that it could go all the way back down here. So that's something to be looking at if we get that hawkishness. Now, why would we get the hawkishness? We have the PCE coming out on February the 29th, which is quite close. And so the problem at the moment is that the market is extremely sensitive to the data, and it's literally going up and going down. But at the moment, the pendulum seems to have swung towards slightly more hawkish inflation data and slightly more hawkish or good kind of the data in the real economy. So it's kind of pushing everything a little bit now down. Now, just a couple of other things as well to be thinking about. I just want to bring your attention, guys, to other parts of the curve. So that's the extreme front end of the curve, by which I mean maybe not like the 5-year or the 10-year, but really like the SOFR contracts, in, let's say, the 2024. But let's say, for example, we look at a couple of other things which are going on, from a sort of a macro point of view. Let's look at the term premium. Now, the term premium, as you guys can see here, it's been creeping. It had been sub-zero. You can see here, this is the 0 point. It's still sub-zero. And the problem is, or what's kind of interesting in terms of the term premium, is that I do believe that this should go higher. Now, remember, the term premium is the extra yield which investors demand if they believe that there's uncertainty about the future path of inflation, if they believe there's uncertainty about the future path of growth, and if they believe there's uncertainty about bond issuance. Now, I would argue that at the moment, and this has changed in the last 3, 4, 5 weeks, we now have, we had the QRA a couple of weeks ago. We have definitely a lot of long-term bond issuance in the coupons, so the 10 years, the 20 years, and the 30 years. So that means that there's going to be more issuance just structurally hitting the market over the next 3, 6, 9, 12 months. That should be a pressure on the long end yields to put the yields up and the price down. That should increase the term premium. Secondly, the issues about growth and inflation. As we've just discussed, we're getting inflation seems to be a bit sticky at the moment. Not to say it's going to accelerate up hugely, but the point is that it's not going down, at least with the latest data, down towards the 2%. It seems to be slightly going up a bit. And of course, with growth, we have a lot of indicators from the real economy that growth is going up. So all of that stuff normally historically puts upward pressure. The long-term bond market gets a bit sort of freaked out, a bit scared, and says, okay, guys, we want more premium to hold long-term bonds. That's the risk. So put that in simple English, what I'm trying to say is that this term premium, which at the moment is still negative, that should probably go up historically another 25 or 30 basis points. And that's mainly going to hit the long end. So let's say the 10, 20, and 30-year bonds. So in theory, that should cause some kind of bear steepening from a structural point of view, which is actually not bad in terms of some of the positions we're holding. The other thing as well, which is kind of interesting just to keep an eye on, is the real yield. So let's just have a look at the real yield, which I've got here somewhere, I think. Yeah. So the real yield, of course, is the nominal yield subtract inflation expectations, and that gets us the real yield. So that's the degree to which the economy is being restrictive. So how restrictive is the Fed being? And that's something. Let's just have a quick look going back to the summary of economic projections, because there's been quite a lot of debate about R star, the famous R with the little asterisk or star, which is where the Fed thinks, the longer term neutral rate is. And what you guys can see here is that if you look at the longer run Fed funds rate, it's been at 2.5% for a long, long time. Some commentators are saying that, in such a strong economy, maybe the neutral rate, which is the rate at which the economy, the rate is neither restrictive or accommodative, maybe this needs to be revised upwards. And some people are saying that this is another thing to look out for with the Fed in March, that maybe they will revise up R star or the neutral rate from not 2.5%, maybe up to 2.75%. The logic being that the Fed believes that the economy is operating with all its energy on all its cylinders, and that therefore it can sustain a more higher interest rates for longer, basically. Okay. So let's have a look and just see how restrictive the Fed is at the moment. So if we go back to the real yield, what's kind of interesting, guys, if we go back quite a long time, so I'm going to take this back to, let's say, I'm going to take it back 25 years, get some historical perspective. So as you can see, this is now a monthly chart. That's where we're at. And what you can see is that this, I mean, it was a little bit more restrictive, a few months ago, but you can see that from a historical perspective, if you go back all the way to what's that kind of the great financial crisis, 2008-09, we haven't had such restrictive kind of rates. So one could argue that we are, in restrictive territory, but it doesn't seem to be affecting the real economy so much. So that is really the big puzzle at the moment, and the big conundrum, as the Fed likes to say, is that, okay, if we are quite restrictive, why is the real economy, doing so well? And maybe the answer to that is that, the market believes that, the economy is strong enough that it can deal with these rates, and that they're not actually that restrictive, and that maybe the real restrictive rate, as we just saw, needs to be more like 2.75% or so to actually start slowing down the real economy, which is another reason why the Fed may cut less and later than they had anticipated or signaled in December. And that's kind of interesting. Okay, so just to sum all that up, that's like a big macro zoom, and then we'll get onto some specific charts in a second. So it seems to me that really, in terms of the bond market, we're in a bit of a position now where I don't think the front end can rally substantially, just because the Fed has signaled to us, and possibly will be even more hawkish in another few weeks, that there's more work to be done. So the front end, I think, is not going to rally too much, but I also don't think the front end can fall massively, because at some point, a lot of pain has already been built into the market. And in terms of the long end, I think the long end is going to be weighed down by issuance and growth, extra growth, and more issuance. So I think we're in a period of kind of very, very choppy markets. We've been in a choppy market period for probably the last 3 or 4 weeks. Unfortunately, I think that could continue until we get clarity from two things. And the clarity will come with the PCE, although mechanically, a lot of people are saying that with the inputs from the PPI and the CPI, mechanically, the core PCE, which we'll get on February the 29th, will go up a little bit. Then we will get another reading of the CPI in the first part of March. And then, of course, we get the Fed. So until we get clarity from the Fed, which I think is March the 19th, I do believe that the bond market, neither the front end or the back end, it's going to be choppy, and it's just going to be whipsawed around by the data. If anything, though, I would have a slight bear steepening bias, just because I believe that with the extra issuance and growth, in theory, that should be more negative for the long-term bonds. We shall see. Okay, so let's just have a quick look now at a few charts, guys. I just want to look at a few bond charts and a few equity charts and commodities. I'll try and do this in about 5 minutes or so. So first of all, let's just have a look at a couple of yield curves, because I know we have a steepener trade on. So let's just look at a few yield curves. If we look at something like, let's start off with the classic one, the 2s10s, which is this guy here. So as we can see, I mean, again, what we're anticipating, if we zoom out a little bit, is that at a certain point, I mean, and let's look at a few different scenarios. We're hoping and expecting some kind of steepening. So we're expecting that this 2s10s, in the 5s30s and the 2s30s, to go up here, then eventually up here. And we know that historically, even after, once the Fed starts cutting, that the true steepening does happen to the tune of 150, 200, 250 basis points. So the curve will steepen. Now, the question is when, and could that be delayed, and will it bear or bull steepen? We have a position with, the TUA, which is essentially the 2 years. So our preferred option, of course, would be a bull steepener, so a front end led bull steepener. But my thesis is that over the next few weeks, we could actually have a little bit more flattening, bear flattening. And very simply, that could be because of higher than anticipated core PCE. And also because if the Fed decides to revise the dot plot and to actually take out half a cut or maybe even a full cut in March, the front end of the curve will not like that. But having said that, I think that will readjust relatively quickly because remember, if the Fed is a little more hawkish, that means that they're combating inflation more aggressively, and technically, that will slow down the economy. So that's the theory. But until and unless that happens, there is the possibility as well that the long end we get a bear steepening, because if the real economy data continues to come in strong and inflation is not going down, sort of almost no matter what the Fed says, the long end bonds could sell off. So we could get a steepening, or we could get a bear flattening, and that's why the markets are very choppy, because the market has to digest real economy data and inflation data, but it also has to try and factor in growth and also the reaction function of the Fed. So there's kind of like four factors which are just moving the market down from one day to the left, one day to the next, either flattening the market, bear flattening the market, or sometimes bear steepening the market or bull steepening the market. So that's where we're at with that. So I think what is interesting to me, though, if we do get down to this level, I think that's going to be a maximum kind of pain point realistically, because we've taken a lot of pain. When I say we, I mean that the bond market has sold off a lot at the front end of the curve and has also flattened quite a lot. So I think in terms of the curve, something around 47, 49 basis points around here could actually be an opportunity to add to the position, because I think anything lower than that mechanically would be very difficult, which is not to say we couldn't get below that. And let's say if we look at another curve, let's say, a bit of a classic one, the 5s, 30s, I think, that could go down a little bit more, maybe to sort of, around this area here, something like about, 5, 6, 7 basis points in the positive down here a little bit. But again, I think anything below that would be, especially on the 5s, would be difficult. And now if we go to have a look at the 2s, 30s, again, interesting to me that it bounced off the Fibonacci level here. You see this Fibonacci retracement. So that's a positive sign. I still think it could go down here a little bit to minus, let's say, 31 basis points. But again, mechanically, I think that's probably going to be enough. Now, why do I say mechanically? In order to look at that, we should look a little bit at a couple of yields. And again, let's just look at what's happened is that if we look at, even since the beginning of this year on the 2-year yield, we can see that actually the market has taken out 60 basis points. You can see here, it's almost like 60 basis points. So a lot of the hawkish repricing since the so-called December pivot, which turned out not to be a pivot, the market has done a lot of the heavy lifting. So I think in terms of our positions, we have taken 75 or 80% of the pain. And I do believe that, up to maybe, 4.75, maybe up to this level, this is the outright 2-year yields. That represents almost a mechanical sort of high. What could drive it higher? I think we'd have to get a pretty extraordinary confluence of factors. We'd have to get extremely strong real economy data. We would have to get a Fed which openly was suggesting that they could hike more, not even to take out some of the cuts, but maybe even add a hike or so. So we'd have to get inflation consistently for 2 or 3 or 4 months, really re-accelerating to the upside. I think that's a relatively low probability scenario at this point. So as I say, I think we're getting relatively close to the 2-year. If we look at something like the 5, similar kind of situation, I think could it go up to 4.4-ish, 4.4.5, maybe even up to 4.5? Maybe, but again, I think that's a bit of a maximum. And again, just quickly, let's look at the 30 at the other end. I think, maybe something around about 4.5, around about these levels. As you can see, this bit of resistance is probably like getting towards an uppermost band. So that could be an interesting buying opportunity there. The other thing as well, guys, if we're talking about this, if we look over in, let's say, the European space as well, just pretty quickly, just want to look at, let's say, I think I've got the 5s, 30s here. You can see that that's been flattening a little bit as well. But I also think that, there's some opportunities there. If we look at, let's say, the yield curve of, let's say, the front of the German curve, I've got my notes here. There's a bit of a gap here, you can see. I think it could test just, the gaps like to be filled in. I think it could test up towards here, 2.91. I think that could actually be an interesting buying opportunity for the Schatz, the front end, the 2-year of the German curves. That's something I'm going to put an alert. I also think for the the 5-year yield in Germany. Similar kind of situation. There's a little gap which needs to be filled up towards here, which is about the 245, 247 basis point level. So I think that's somewhere we could potentially think about entering into. So just talking about Europe, just where I've got some notes here. Actually, before I do that, I just want to quickly have a look here at something else which I've been keeping an eye on, which is the Italian-German spread. Where is that? I've got it here somewhere. Oh, here we go. Okay, so what's interesting, guys, is that if we look at the Italian-German spread, obviously, as you can see, that had been, 4 or 5 months ago, had gone out to about 210 basis points. As you can see, it's obviously going downwards. And that's interesting because that is essentially saying that the market at the moment is relatively confident that the Italian political situation and debt situation is under control. So that's a bonus point to Meloni's government. But it's also telling me that, investors are looking to get a bit of a pickup in yield. So they're preferring, the Italian bonds over the German bonds. But that could reverse quickly. But at the moment, the idea is that with political stability and fiscal stability in Italy, this is maybe something which maybe has a bit more room to run on the downside. So again, I would say that any rally, let's say if it rallies up to 159, 160 basis point spread, I think that could be actually a sell. Now that could be a sell, until we get imminent cuts from the ECB, and we're not there yet. The ECB as well is scheduled. The market is pricing in a June cut. So I think any sort of short-term rally in the Italian-German bond spread, I'll be looking to maybe sell that around about there. The other thing as well, just very quickly, we don't talk about it much, but also in France, if we look at the French, I don't know if I've got that on the French 10-year. I think I've got that here somewhere, if we can see that. There we go. The French 10-year as well. I think I've put an alert up here. If that gets up to, around about the 300 basis points level, I think there's no reason for that to go too much higher. So I think around here could also be quite interesting to be, at this point, to be buying the French 10-year on the futures of the oats. So that's in Europe. And just some other general notes I've just got here on Europe and versus the Fed. So what's going on here is that I think we're starting to get to a point where if you actually look at the pricing, in Europe, the pricing is for a June cut, but it's also the same as the pricing for the US. So both markets are pricing in a cut in June. But what's interesting, and I won't bore you with all the details, but I did do quite a lot of research over the weekend, is that if you look at the real economy data, there's starting to really be a divergence, which should be reflected in the bond market and therefore possibly trading opportunities over the next 4, 6, 8 weeks, I'd say is maybe an appropriate time frame. Because if you look at growth, the growth in path in Europe is sort of plateauing and is getting to a point where it's starting to slow down, which is not the case as we saw in Europe. And the GDP, as we saw in the US, is expected to go up towards 2.9 or 3%. In Europe, it's much less. It's in the ones, between 1 and 2%. We also see that the path of inflation in Europe, it hasn't ticked up again. Inflation, core inflation and headline inflation in Europe is definitely still trending downwards. We also see that R-star, or the neutral rate in Europe, is definitely seems to be lower than in the US. So what does that mean? It means that the ECB's current policy is actually much more restrictive on the real economy than in the US. So that should slow down the economy in Europe as well. We also see that wages, in Europe, they have a lot more collective wage bargaining. And basically that it seems that we've seen in Europe peak wage rises. And a lot of the stuff I was reading over the weekend is saying that the upcoming spring wage agreements in Europe are expected to be relatively calm. So what that means is that wage-based inflation should have reached peak. So all that to say here that that the differential should start favoring a more dovish ECB. So there's kind of two scenarios. And again, scenario A could be that the ECB is cognizant of these factors and says, hey, our economy is weaker, our policy has been actually more restrictive, inflation is trending the right direction for us, and that our growth is less. Therefore, we could have a scenario where the ECB actually starts to cut before the Fed, and maybe even more aggressively than the Fed. Okay, we're not at that situation yet. And if you look at the differentials, which I could maybe just as we're talking about this stuff, I think we've got this one here. So this is the US 10-year, subtract the German 10 years. And as you guys can see, it's pretty much in a range. But my point is that if we continue to see this sort of divergence, what could happen is that the US yield compared to the German 10-year yield could start to blow out a little bit more. And we could see this sort of heading up more towards the 2%, 210 basis point, maybe over the next, maybe timeframe 4, 6, 8 weeks. So one scenario would just be that the ECB says, yep, we need to cut sooner than the Fed, no problems. But another scenario, which is maybe kind of more dramatic, is that the ECB continues to be led a little bit by the Fed and continues to say, well, as long as the Fed is not cutting, we will not cut. And that scenario is a scenario where the ECB waits until the Fed cuts, but because they've waited almost too long, that will have a more dramatic effect on their economy, and their economy will deteriorate more than the Fed. So what does that mean in market terms? It means that maybe if the ECB waits too long, like until June or July, and only cuts once or twice, they may be forced to cut more aggressively and more quickly than the Fed, let's say in the second half of 2024, which of course would have implications for this differential on the spread, which of course has implications for the euro. That would imply maybe a euro weakening against the US dollar, for example. So that's something which we need to be looking at. At the moment, it's just trading in a range here, that differential. But that's also, I think there could be some opportunities, not now, but maybe in a 4, 5, 6 week time frame, when the tension starts to become a little bit too much internally for the ECB. So we'll see. That's something to be looking out for. So just getting back, guys, just let's continue here. I'm not going to say too much about the US dollar. I've just sort of spoken a little bit about it. Obviously, what I would say, though, is that the US dollar, if we look, I'm going to throw this onto a weekly chart, just give us a bit of perspective. And we can see here that the dollar index, which is quite Euro-centric, obviously, it's about 58% Euro, and doesn't have the Chinese renminbi, for example. But as you guys can see on a weekly chart, the US dollar has been pretty strong. It's been grinding upwards. Now, the big multi-million-dollar question is that justified? Will it continue? Okay, is it justified? I would say yes, in a sense, because the Fed, the market has sort of repriced with a hawkish bias over the last, well, exactly 6 or so weeks. The question is, is it justified? I do believe, and I'll get when I talk about equities in a second, if this, let's say, for example, it starts to flatten out a little bit here, I think this would be a great buying opportunity. I've got a level here. I wrote down about 101.9, 102, something around here. I think would be a great buying opportunity, because I do believe that further into the year, let's say Q2, let's say Q2, April, May, June, something like that. Gradually, there will be a divergence between the Fed and, let's say, the ECB, and that if the dollar index does come down towards this level, I think that would be a great buying opportunity. Maybe some call spreads on that. I think that'd be an opportunity. We're not there yet. On the other hand, would we be wise in selling the dollar? I don't think so, because at this point, you've got to say, no other major central bank is going to be more hawkish than the Fed. They may match the Fed, or they may be more dovish, but to be more hawkish than the Fed, I think that's low probability. So I think at this point, it's kind of a no trade. I think the best thing would be to wait there, but definitely have an alert around about here that would represent a pretty good value. And a similar thing, I think, if we just have a quick look at the euro, it's a similar kind of story here, that the euro, again, up around here would be a great buy. A great sell. Okay, again, do we want to be buying the euro here? Maybe, but again, I can't see the ECB being particularly more hawkish than the Fed. So again, I think it's a question of maybe selling the euro up here. The level I have is about 108.80. Up here, somewhere like that would be kind of an attractive entry point, potentially. Again, that's something for an alert. Now, in terms of commodities, guys, just want to have a look at, let's say, DBC, which is a good sort of general commodities index. And what you guys can see here, again, this is on the weekly. We'll just keep it on the weekly. It's kind of just stuck in a range. And that's interesting, because some of the energy products, the refined products like gasoline, heating oil, diesel, they've been actually quite strong recently. And even crude oil is doing okay. But my point is that commodities is finding it hard to break out. And that's a little bit of a tricky question, or an interesting question, because on one hand, which we were talking about at the beginning of, of our little video here, is that there's this kind of growth thing. It's like, oh, the US is in a growth path, the US economy is doing strong, is doing well. So if that's the case, why is something like DBC, and I'll put it back on a daily, why is DBC just kind of ranging here? Why isn't it breaking up? Now, that could be because of China. We know that the Chinese market is flat and weak. Just politically in China coming up, there's what they call it, the Two Sessions meeting is coming up in a few weeks. Some people are saying that there might be some stimulus, but at the moment, I think commodity space in general is going to find it hard to rally. What I would say, though, is that if it actually can break this level, there could be more downside. So that's something to be looking for as well. Maybe selling into some of this weakness if it goes down. But again, just seems to be range bound at the moment. So not a huge amount to say there. Again, if we're looking at gold, I don't particularly love gold. There's, again, just range trading. I think at $2,000 around about here, that could be an interesting buy. Maybe it'll get up to here, but I think it's just in the middle of a range here. There's not a huge amount to say about gold. Just quickly, oil. Excuse me. Want to have a look at oil. Oil is an interesting one. As I say, if we look at some of the products, like you look at gasoline, it's been pretty strong. That's not a gap up. That's just a contract roll. Gasoline has been doing relatively well. Diesel has been doing quite well. Heating oil has been doing quite well. But if you just look at the crude, it has been grinding up. But again, it was rejected twice at this big Fibonacci level. So if we just look at sort of a longer term perspective, we can see that, around about this 50% fib was rejected back in, November, December. It was rejected earlier in the year. And although this price action does look, relatively positive, it's higher highs and, well, higher lows, let's put it that way. We still have not got above this very, very key 79.50 level. And that makes sense because, as I won't go into the details, but we know that there are different on the supply side, the supply and demand, we can argue on both sides. The Saudis are trying to cut supply, but on the other hand, there hasn't been perfect compliance with other members of OPEC Plus. We also know that in countries like Guyana, they've just discovered huge new oil fields. The Saudis have a 3 million barrel per day spare capacity, which they can turn on at any point. So the point is, yes, et cetera, et cetera. I'm not going to go through all the arguments. It's a very balanced market. And I actually believe that when and if we get up to this level, 79.50, from a trading perspective, I think I want to see a clear break of this and then a retest. And if that cannot retest higher, I think actually there could be an interesting candidate for a short, maybe some put spreads, long put spreads or something like that. Maybe some long put spreads on the USO. On the other hand, if it has strong price action towards there, I would also be looking at the calendar spreads and the refined products. If all of those things are going in the right direction, maybe it could be a candidate for the other way. So I think basically all of that to say that until and unless we get some change in the geopolitical situation, in the supply situation, or clear evidence that the global economy, by which I mean China included, is either accelerating or contracting, I think we just have to look at price action around about this key level and then, let it play out for a day or two and then maybe give it a shot with probably, I think, some option spreads would be the best way rather than doing outright on the futures, which is going to be a little bit too choppy and volatile. So that's oil. So finally, guys, just a couple of comments about the equities. Why don't we start off? I mean, again, I'm not going to go into too much, but we know that the Magnificent Six, those top 6 stocks, have been really the ones pushing all of the gains. So if we just have a quick look here at those, but specifically NVIDIA. Now we know that NVIDIA has, I was reading something on the weekend that NVIDIA has been one of the main engines of the push up in the NASDAQ index and even in the S&P 500. And the point here is that if we have NVIDIA earnings, of course, upcoming on Wednesday. And I think that's going to be a very, very big deal. Just first of all, let's look at NVIDIA. And what you guys can see that in the last 2 or 3 earnings, we tend to have had a run up going into the earnings and then a bit of a buy the rumor, sell the news kind of situation. And generally we've had a run up going into the earnings and it's sold off for, a week or two. Then, as you can see, earnings is run up into the earnings, then it's sold off into for a week or two, and then it's continued upwards. Could it be, and again, this is no kind of, future prediction, but obviously we've had an explosive run up in Nvidia. We have earnings in a couple of days. Could it be that even if the earnings are, relatively positive, and obviously if they're less than expected, that's going to be pretty nasty. But let's keep in mind that Nvidia does tend to sort of blow off or sell off a little bit for 2 or 3 weeks after the earnings, and then maybe resume. So if that's the case, and obviously if the earnings are a disappointment, we can expect a fairly aggressive sell-off, not only in Nvidia, but in that sort of Mag 6 kind of tech space. Could we expect therefore, and I'm just going to go back to the, let's say something like, let's say the NDX, the cash market here, could we expect a little bit of a sell-off in the equity space post Nvidia? That's my point. Not a huge sell-off, not a structural sell-off, but just like a bit of a breathing room. And what I did here, just put on the chart, this is the NDX, so the cash index, which is a bit more stable than the futures. As you guys can see, if we look at, let's say, a Fibonacci extension, a longer term one, you can see that we're starting to, have some of the measured move. We're sort of starting to get into, the extension, like we're getting to some of the limits here. And also, if you look at a second one, which is much shorter term, you can see that's around about there. So all that to say that just from a technical perspective, we are, we've come a long way over the last 2 or 3 months. And just from a sort of a robot, sort of systematic point of view, there could be more upside, but a little bit of a sell-off. And who knows, maybe Nvidia could be the reason for that. It would not surprise me, especially with the NASDAQ space. We get a bit of a sell-off, maybe for a week or two, just a bit of profit taking. But what I would say is that if we continue to have bonds being relatively stable and not really changing that much for another 3 or 4 weeks, could it be that, let's say, there could be a buying opportunity? And I looked at a couple of levels here, and I've got something like about 16,950, which, works out, where's that? Around about here, yeah. What I'll put it here, about 16,950. I think we might be looking from a point of view to get in with maybe some call spreads, looking for just a nice little 1 or 2% sort of sell off here. I think that would be good risk return, because I can't see fundamentally, at least for the next few weeks, why that should sell off. I can see why it might sell off later in the year if term premium goes up and we get a more hawkish Fed also, but we'll have to see. Also, looking at, let's say, the SPX, a cash market, a bit more stable. Same kind of deal here. I think around about, the 4,900 level could be interesting entry point for some call spreads. Again, based on this idea that we're technically overextended on all the technical measurements, Nvidia historically could lead to a little bit of a short-term, pause. And that would just be a nice little healthy retracement. There's definitely something to be looking at. The other thing I just want to finish off on, guys, is just looking at emerging markets. And what's kind of interesting, I just put on a chart here. If you look at the basic emerging markets ETF, the EEM, and let's say divide it by something like the SPY, kind of interesting just to see where we are, guys. If you look historically, look where we are. Now, the EEM, emerging markets, has been outperforming just over the last week or two. But if you put this on a longer term chart, and if you go back on a weekly, it's even pretty crazy, just going back on the weekly here. Look at that. The point is that, can the emerging markets outperform the SPY to the upside? I'm not saying they will, but there's certainly a huge amount of potential upside. I'm not saying it's going to get up here, but if we just go back to a daily chart, and it's possible it could outperform a little bit. And if we just go back to the EEM, I'm just thinking, maybe up towards this $42 level. I mean, it's already come a little bit of a way, but it's kind of an interesting, 3 or 4 or 5% move possible. Now, why would that be? And this is a short-term tactical thing. Why would that be? It could be that, the dollar, just might take a little bit of a pause. It could be, and this is based on the fact that maybe post Nvidia, if we see the SPY, let's say the S&P 500, and we see the NASDAQ, and generally the US stocks having a little bit of a tactical break for, a little bit of a pause for 2 or 3 weeks, it could be that the emerging markets, just have a little bit of an outperformance as a little bit of money flow goes in emerging markets. I'm not saying it's a guaranteed trade, but it's just interesting when you just see how much the emerging markets have underperformed over the last sort of 18 months versus SPY. I think any weakness in the US equity space could be an opportunity for a short-term tactical, at least a little, toe in the water. And we could do that as a spread trade, maybe long EEM versus short SPY as a kind of a spread trade. Just a little something to look at there. Okay, so I think I'll leave it there and I'll stop recording now. So hope that's interesting.